Most people think their financial problems are math problems. Too little income, too much debt, wrong timing, bad luck. But for a lot of people, the actual problem is quieter than that. It's the version of themselves they're trying to protect in every financial decision. Someone gets a raise and immediately upgrades their car, not because they needed it, because the old car felt like the old them. Someone refuses to take a side job because the work feels beneath their level. Someone avoids looking at their account balance because knowing feels worse than not knowing. All of that is ego doing financial work. And ego is expensive, quietly, consistently expensive. It doesn't show up on your bank statement as ego. It shows up as lifestyle inflation you didn't plan for. It shows up as opportunities you passed on because the optics felt wrong. It shows up as debt that started as image and never got corrected. Ego spending isn't always loud. It's not always the flashy watch or the luxury trip. Sometimes it's the restaurant you suggest because you don't want to seem budget conscious. Sometimes it's not negotiating a bill because asking feels embarrassing. Sometimes it's paying full price to avoid looking like someone who checks prices. These are real costs. Small individually, but they compound. $30 here, $100 there, a missed negotiation worth $300 a year. Over time, the gap between what you earn and what you build quietly widens. And most people never trace it back to pride. They trace it back to income and then go looking for more income to fix a behavior problem. The earning is fine. The identity attached to the spending is the issue. There's a version of this that looks completely rational on the surface. Someone keeps a subscription they don't use because canceling feels like downgrading. Someone carries a credit card balance on a premium card because the card itself signals something. The interest rate is 24%. The signal costs real money every month, but the card stays because cutting it feels like admitting something. That's ego with an APR attached. A lot of financial self-sabotage lives in that exact zone, the place where identity and spending overlap and logic quietly exits. And the overlap is usually around status, appearance, and what other people might assume, not what they actually think, what you imagine they might think. That imagined audience is costing a lot of people serious money. The colleague who doesn't know what car you drive, the neighbor who genuinely isn't tracking your lifestyle, the social circle that's too busy managing their own image to monitor yours. You're performing for an audience that's mostly not watching, and the performance has a monthly fee. The tricky part is that ego doesn't feel like ego when you're inside it. It feels like standards. It feels like self-respect. It feels like I've worked hard and I deserve this. And sometimes that's true, but sometimes that framing is doing a lot of cover work. The person who says they deserve the upgrade after a hard year, ask them what their emergency fund looks like. Ask them what their net worth did that same year. Not to shame the purchase, but to check if I deserve this is a reward or an escape. Because ego spending often shows up right after a financial stressor. The account takes a hit, the anxiety spikes, and the response is to buy something that feels like control. A new outfit, a dinner out, something that makes the situation feel less small. It's emotional regulation dressed as a purchase. And it works for about 48 hours. Then the balance is lower, the anxiety is back, and the cycle continues. This is one of the more invisible patterns in personal finance. It doesn't look like recklessness from the outside. It looks like someone living their life, treating themselves, staying motivated. The financial damage is slow and cumulative, not sudden, which makes it harder to catch and easier to rationalize. Now add debt into this picture, and ego makes it significantly worse. Because ego doesn't just drive spending, it drives avoidance. A lot of people won't open a debt payoff calculator because the number is confronting. They know it's bad. Seeing exactly how bad feels like an attack on their identity. So they don't look. They pay the minimum. They move on. The debt grows. The interest compounds. The number gets worse. And the avoidance becomes permanent because the longer you wait, the more confronting the number becomes. Ego protects you from the discomfort of knowing and hands the win to interest. There's also the version where ego blocks income. Someone qualified for a job won't apply because the title feels like a step back. Someone with a skill won't charge for it because putting a price on it invites rejection. Someone won't ask for a raise because asking feels vulnerable, and vulnerability feels like weakness. These aren't small decisions. A missed raise of $5,000 a year is $50,000 over a decade. Before you factor in what investing that gap could have done, the ego tax on income is just as real as the ego tax on spending. It just shows up in what never came in, rather than what went out. And both sides of that equation matter when you're trying to build something. There's a behavior that shows up a lot in people who are quietly stuck financially. They talk about money in a way that sounds sophisticated, but they've made very few actual moves. They know the terminology, they follow the content, they have opinions on macro trends and asset classes, but their savings rate is low, their debt is unresolved, and their net worth isn't moving. Knowing about money and doing the unglamorous work of managing it are different things. And for some people, the knowing becomes a substitute for the doing, because being financially informed feels like being financially responsible without the friction. So what does ego actually cost over a full financial life? It's hard to put one number on it, but the shape of it is consistent. Slower wealth accumulation than your income should have allowed. Debt that persisted longer than the math required. Income left on the table because asking felt uncomfortable. Investments delayed because starting small felt embarrassing. That last one is more common than people admit. Someone waits to invest until they have a real amount to put in. Because investing $50 a month feels insignificant, almost laughable. So they wait until they can do it properly, meaning impressively. And the waiting is where the compounding gets lost. Time in the market is the actual advantage for most people. Not the entry amount, not the strategy, not the platform. The years, and ego burns some of them waiting for the right image to begin. The correction here isn't a mindset speech. It's a specific habit shift, learning to separate your identity from your financial decisions. That sounds abstract, so here's what it actually looks like in practice. It looks like checking your net worth monthly, even when the number is uncomfortable. It looks like negotiating a bill without framing it as something to be embarrassed about. It looks like taking the higher-paying job, even if the title sounds lateral. It looks like starting the investment account with whatever you have right now. It looks like asking the question you've been avoiding because not knowing is costing you. None of that is glamorous. Most of it is quiet and slightly uncomfortable. But that's exactly where real financial progress tends to live, in the decisions that don't perform well for an audience. There's a useful internal question worth running on financial decisions. Not, can I afford this? Because ego will always find a way to say yes. The more honest question is, would I make this same decision if nobody would ever know? If the answer changes, that's useful information. It means the decision is at least partially about image, not outcome. And image-driven financial decisions have a poor long-term return, generally speaking. That doesn't mean every visible purchase is ego-driven. It means the ones made primarily for external validation tend to cost more than they return. Over years, the people who quietly build financial stability are often not the ones with the most impressive surface. They drive unremarkable cars. They don't announce financial moves. They're comfortable being slightly underestimated. That comfort with being underestimated is genuinely rare. And it might be one of the more underrated financial advantages a person can develop. Because if your self-worth isn't tied to your spending, the pressure to perform disappears and the money stays. Ask yourself what financial decision you've been avoiding, because starting small, asking out loud, or admitting the number feels like too much. That's probably where the work actually is.